Hi, Jim Gore from Thor Wealth Management. Well, there's a debate that's been going on for a number of years in the investment world whether you should have active management versus passive management. And the answer to that is it depends. It depends on what sector you're going into and what part of the market at that time is going to do well. And what do I mean by that is that broader areas, that there's more opportunities, you probably want to have active management versus smaller areas. And let me give you an example. Back in 1997 to 1999, that's when U.S. large companies, especially U.S. large company growth, did very well. The S&P 500 did very well. It was very difficult for any active managers to outperform. However, from 2000 to 2008, active managers outperformed the S&P 500. And then if you look at the last 3 to 4 years, it's been very difficult for managers to outperform the S&P 500. So we're hearing people say you should always have passive indexes, and that's because of the most recent performance. Now, I will tell you that U.S. large company growth, because it is such a small part of the market, is probably an area that does make sense to go ahead and use index funds for that, because it's much more difficult for those managers to outperform those indexes. However, as you start spreading out the universes, it starts getting better, and those active managers have a better opportunity to outperform. And that's especially in value, a small company here in the United States. But then when you go overseas, there's a lot more opportunities overseas, and especially in emerging markets and emerging markets small company, because those indexes won't be able to capture what is actually going on. And there's a lot more opportunities if you have a manager that's doing research out there to get into some of those positions. Now, you could sit there and say, Jim, well, what do you mean active management doesn't outperform? Well, let me give you a great example, which is the fixed income market, which is a very broad market. Not only do you have corporate bonds, treasuries, mortgage-backed securities, but you also have different maturities. You can buy one out 1 year maturity, 2 years, 10 years, 30 years out maturity. So it's a very broad market. And well, let's look at what has happened over the last year. And this is looking at Morningstar. You can look at the different segments of the fixed income market, whether you're in the intermediate core here in the United States, high yield, emerging markets, or world debt. You can see that 90 to 95% of those managers over the last year have outperformed their respective indexes. The worst one is high yield, and even that, the active managers, 80% of them have outperformed the indexes. Now, the reason why they've outperformed is twofold. One is getting into different sectors, not being heavily weighted into treasuries. And second is in their duration. Now, let me talk about the duration and what has happened there. If you look at this chart here, this is looking at the yield curve. And you can see that the yield curve has steepened over the last year, really measurably since the end of December of this year. And with that increase in the steepness of the yield curve, many people are seeing for the first time in their 401k plans, their fixed income funds had negative return. And that happens because these funds are further out in maturity. Well, the reason why, so because of this, the way that an active manager in the fixed income can outperform is by having lower duration or lower, average yield to maturity in their bond portfolio. And that is what has actually happened. The average, if you look at this chart, has been about 1 year less, 0.8 years. The top performing ones have been 2 years less in duration. The average duration for the index is a little bit over 7 right now, so they're significantly less in duration. But even the top or 70th percentile, their duration was actually lower than the index. So active management, especially in fixed income, because there's a broader market, you can perform much better. And that's why we like active management on the fixed income side, because they can take care of opportunities like this and move around in a broad market like that. We also like the active management today, and we have a higher weighting in international and especially emerging markets small company. We like the active managers there because they can take advantage of the opportunities and get into some of these smaller companies and outperform the indexes because of what they're able to buy. As always, feel free to reach out to us with any questions, and we look forward to seeing you in a couple weeks. Take care.